I think we've all been fooled by the same number. Every few months, a headline appears that looks something like this. The U.S. national debt hits another record, $37 trillion. Soon it'll be 38, then 40. The number keeps climbing. And every time it does, millions of people ask exactly the same question. Who's going to pay all of that back? It sounds like the obvious question. I thought so too. In fact, I spent years believing that paying off the national debt should be one of the government's biggest priorities, because that's what responsible people do. If you borrow money, you pay it back, right? Then I discovered something that completely broke that way of thinking. Rich countries aren't trying to pay off their debt. Not next year, not in 50 years. For the most part, not ever. That sounds irresponsible, almost reckless. Until you realize we've been looking at government debt through the wrong lens this entire time. Because a government isn't trying to win the same game you are. You and I borrow because we don't have enough money today. Governments often borrow, even when they do. And that isn't an accident. It's by design. The strangest part? If the United States suddenly announced that it was going to eliminate every dollar of its debt, many economists wouldn't celebrate. They'd worry. That idea completely confused me. How could paying off debt possibly be bad? So I started reading economics papers, central bank reports, government debt auctions, history. And the deeper I went, the more I realized the debt itself wasn't the interesting part. The interesting part was why the entire financial system wants governments to stay in debt. Once that clicked, those terrifying debt headlines stopped looking terrifying. They started looking incomplete. By the end of this video, you'll understand why wealthy countries intentionally keep borrowing, why paying everything off isn't the goal most people think it is, and, more importantly, how to tell the difference between debt that's quietly doing its job and debt that's becoming genuinely dangerous. Because, despite what the headlines suggest, those are not the same thing. Whenever this topic comes up, someone eventually says the same sentence. The government should run its finances like a household. Honestly, that sounds perfectly reasonable. Spend less than you earn, don't pile up debt, live within your means. If your family ignored those rules, you'd eventually go broke. So why shouldn't governments follow them too? The first time I really thought about this, I couldn't find a flaw in the argument. It felt like common sense. But common sense has a weakness. It usually works, until the situation changes. Imagine I asked you this question. Which is heavier, a kilogram of feathers or a kilogram of steel? Your brain immediately pictures the steel. Dense, solid, heavy. But of course, they weigh exactly the same. Your intuition was fooled because it relied on the wrong comparison. That's exactly what's happening here. We're taking the rules that govern a household and assuming they also govern an entire country. They don't. Not because countries are somehow above economics, because they're playing a completely different game. Think about your own life. You have one career, one income, one lifetime. If you borrow money today, there will eventually come a day when someone expects that debt to disappear. Maybe before retirement, maybe when you sell your house, maybe through monthly payments over 30 years. But eventually, the clock runs out. Now ask yourself something strange. When does the United States retire? It doesn't. When does Japan stop existing? When does the United Kingdom reach the end of its working life? They don't. Governments outlive every politician, every billionaire, every company, every person watching this video. That changes the mathematics completely. A household is trying to survive one lifetime. A country is managing an economy that keeps replacing itself generation after generation. Children become workers. Workers become retirees. New businesses replace old ones. Innovation creates entirely new industries. Taxes continue flowing. The economy keeps moving. That doesn't mean governments can borrow without limits. They absolutely can't. But it does mean something incredibly important. The debt isn't attached to one person's future income. It's attached to the future of an entire economy. And that's a completely different thing. There was one word that kept showing up while I was researching this. A word I'd heard before, but never really understood. Rollover. At first I ignored it. It sounded like technical jargon economists throw around to make simple ideas sound complicated. Then I looked into it, and I realized this single concept explains almost everything. Because once you understand what rolling over debt actually means, the national debt starts looking completely different. Let's say you lend the US government $1,000. You don't hand it over with a handshake. You buy something called a Treasury bond. Think of a Treasury bond as an IOU. The government says, lend us $1,000 today. We'll pay you interest. And in 10 years, we'll give you your $1,000 back. Simple. No magic, no hidden tricks, just a promise. Millions of these promises are sold every year. Some last a few months. Some last decades. Banks buy them. Insurance companies buy them. Pension funds buy them. Foreign governments buy them. Even central banks buy them. At this point, I thought I understood the system. Government borrows money. Government spends money. Government eventually pays the money back. End of story. Except, that's not the end of the story at all. Imagine 10 years pass. Your Treasury bond finally matures. This is the moment I expected the government to open some giant vault, pull out your $1,000, and hand it back. That's not what usually happens. Instead, the government sells another bond. A new investor buys that bond. The money from the new bond is used to repay the old one. The old debt disappears, the new debt takes its place. That's it. That's what economists mean when they say governments rolled over debt. When I first learned this, it felt almost like cheating. Wait, isn't that just borrowing money to pay back borrowed money? It sounds suspiciously like someone moving debt from one credit card to another. I thought exactly the same thing. But then I realized I was making the same mistake again. I was comparing a government to a household. Imagine instead that you own a successful business. Every few years, one of your business loans expires. Do you shut down the company to pay everything off forever? Probably not. If the business is healthy, profitable, and still growing, you refinance. Not because you're in trouble, because keeping access to capital allows the business to keep operating. Governments think in a surprisingly similar way. The goal isn't to eliminate borrowing. The goal is to make sure borrowing remains sustainable. That's a completely different objective. This made me curious about something else. If governments keep replacing old debt with new debt, who keeps buying it? Because eventually people should say, no thanks, you've already borrowed enough, right? Except they don't. In fact, there's usually enormous demand. That completely confused me. Why would anyone voluntarily lend money to a government that already owes trillions? What do they know that everyone staring at the debt clock doesn't? That question led me to something I hadn't expected. Government debt isn't just something governments need. It's something the entire financial system depends on. And once I understood why, I stopped seeing government bonds as evidence of a problem. I started seeing them as one of the most important products the government actually creates. Imagine tomorrow morning, every US Treasury bond vanished. Not defaulted, not paid off, just gone. At first, that sounds incredible. No national debt? Problem solved. But then another question appears. Where does everyone put their money? Not your savings account. I'm talking about trillions of dollars. Money belonging to pension funds, insurance companies, banks, central banks, investment funds, multinational corporations. All of these institutions constantly need somewhere that's safe, liquid, and reliable to store enormous amounts of cash. You can't park trillions in a checking account. You can't throw pension money into meme stocks. You can't bet an insurance company's reserves on crypto. You need something incredibly boring. And boring is exactly what government bonds are. They're not exciting. They're not supposed to be. They're designed to be predictable. That's what makes them valuable. And suddenly, the question changes. The government isn't asking, who wants to lend us money? The financial system is asking, where are the safe assets we need? That completely flipped my understanding. The debt wasn't just a liability, it was also an asset. Every Treasury bond the government owes is something someone else deliberately chose to own. That means the debt clock is only showing one side of the balance sheet. It's counting the government's obligation. It isn't showing the millions of investors, institutions, and countries that consider those same bonds among the safest investments on Earth. That's a very different story. But that creates an even bigger mystery. If governments can keep rolling over debt, and investors keep buying it, why doesn't every country just borrow forever? Surely there has to be a limit. There is, but it isn't the one most people think. In fact, it's probably the biggest misconception surrounding national debt. Because contrary to what the headlines suggest, the most important number isn't how many trillions a country owes. It's a completely different number that almost never makes the news. If you spend enough time reading comments under videos about government debt, you'll notice something. Almost nobody argues about how the debt works. They argue about how big it is. 37 trillion, 38 trillion, 40 trillion. The conversation almost always ends there. Because our brains are wired to react to big numbers. And to be fair, those numbers are ridiculous. They're so large, they're almost impossible to picture. If I asked you to count to 1 trillion without sleeping, it would take over 31,000 years. So, yes, the number deserves your attention, just not for the reason most people think. Here's a question. Imagine I tell you someone owes $500,000. Is that a lot? You can't answer. Not yet. Because I deliberately left out the most important piece of information. How much do they earn? If they make $35,000 a year, that's terrifying. If they make $20 million a year, it's barely a headline. The debt didn't change, only the context did. And suddenly, your conclusion changed completely. That tiny thought experiment explains one of the biggest mistakes people make when talking about countries. They focus on the debt, without asking about the economy carrying it. This is where economists use a term that sounds intimidating, but is actually very simple. Debt to GDP. GDP is just the total value of everything an economy produces in a year. Every coffee sold, every car manufactured, every haircut, every software subscription, every hospital visit, every factory. Everything. Think of GDP as the economy's annual output. Or, if you want a simpler mental model, its earning power. Now imagine two countries. Both owe $1 trillion. One produces $500 billion worth of goods and services every year. The other produces $10 trillion. Who would you rather lend money to? Exactly. Same debt, completely different capacity to handle it. That's why economists rarely obsess over the headline number by itself. They're asking a different question. Is the economy growing fast enough to comfortably support the debt? Once I realized that, I started seeing debt headlines almost like someone's bathroom scale. Knowing a person's weight tells you something, but without knowing their height, it doesn't tell you nearly enough. A 6'5" basketball player and a 5' office worker can weigh exactly the same. That number means something completely different depending on the context. Debt works the same way. The number alone isn't meaningless, it's incomplete. Then I came across Japan. And honestly, Japan broke my brain. Because according to the internet, Japan should have been in constant crisis. Its debt-to-GDP ratio is over 200%. That means the country's debt is more than twice the size of its annual economic output. If debt alone determined whether a country survived, Japan should have collapsed years ago. Except, it didn't. In fact, Japan has carried extraordinarily high debt levels for decades. Its economy has struggled with slow growth. Its population is aging. Inflation was unusually low for years. It has faced plenty of challenges, but the debt itself didn't trigger the disaster many people expected. That forced me to ask a much better question. What did everyone miss? Because clearly, there had to be another variable. Actually, there were several. The first one surprised me. What currency is the debt borrowed in? That sounds like a technical detail. It isn't. Imagine you live in India. You earn rupees. Your salary arrives in rupees. Your savings are in rupees. But somehow, your mortgage is in US dollars. Now imagine the rupee suddenly loses value against the dollar. You didn't borrow another cent, but overnight, your loan became much more expensive. Not because the bank changed anything, because the currency moved. Countries face exactly the same risk. If a government borrows heavily in a foreign currency, it creates a problem. It has to earn or obtain that foreign currency to repay the debt. If its own currency weakens, repayment becomes dramatically more expensive. And unlike debt issued in its own currency, it can't solve that problem simply by operating within its own monetary system. This is one of the reasons emerging market debt crises have happened throughout history. Not because governments woke up one morning and decided to fail, but because borrowing in someone else's currency can become brutally expensive when exchange rates move against you. That realization changed the way I looked at another common argument. People often say, debt is debt. Not really. Debt in your own currency and debt in someone else's currency can behave like two completely different financial instruments. But currency is only part of the story. There's another question that's just as important. Who actually owns the debt? Because that turns out to matter far more than I ever expected. At this point, I realized something that completely changed the way I read economic news. Whenever I saw a headline about the national debt, I stopped asking how much. Instead, I started asking three different questions. What currency is the debt in? Who owns it? How expensive is it to keep borrowing? Those three questions tell you far more than the number itself ever will. Let's start with the second one, because it's surprisingly overlooked. Think about borrowing money from two different people. In one scenario, you borrow from your parents. In the other, you borrow from a complete stranger who expects every payment on time. The amount is identical. The experience isn't. One lender knows you, trusts you, understands your situation. The other is looking at a spreadsheet. Countries experience something similar. Take Japan again. A huge portion of its government debt is owned by Japanese investors, Japanese banks, Japanese pension funds, Japanese insurance companies, even the Bank of Japan itself. In other words, a lot of the money never really leaves the country. The government pays interest. That interest often ends up in the hands of Japanese institutions. Those institutions pay wages, invest dividends, provide pensions. The money keeps circulating inside the same economy. It's still debt, but it's a very different situation from borrowing heavily from investors halfway across the world. Now imagine another country where most of the debt is owned by foreign investors. Those investors don't vote there. They don't live there. They aren't emotionally attached to the country's future. They're making an investment. If they lose confidence, they can stop buying new bonds or sell the ones they already own. And that's where things become interesting. Remember what we learned earlier. Governments usually don't pay off old debt from a giant pile of savings. They replace old bonds with new ones. That system only works if investors continue showing up. So what happens if they don't? The government has to convince them, and the easiest way to convince investors to lend money is to offer a better return, which means higher interest rates. Here's something that surprised me. Debt crises don't usually begin because a country suddenly owes a huge amount of money. That debt often built up gradually, over years, sometimes decades. The crisis begins when confidence changes. Imagine you're lending money to your most reliable friend. You're happy charging 3% interest because you're almost certain you'll be repaid. Now imagine you suddenly aren't so sure. Would you still lend at 3%? Probably not. You'd either ask for a much higher return or refuse to lend altogether. Financial markets behave exactly the same way. The safer investors believe a government is, the lower the interest rate it usually pays. The more uncertain investors become, the more expensive borrowing gets. And that's where debt can become dangerous. Not because yesterday's debt suddenly changed, because today's borrowing became much more expensive. This was the biggest click moment for me. It's also the one I almost never hear outside economics. Imagine you own a small business. Every year, your revenue grows by 7%. Your loan costs you 3%. You're growing faster than your debt is costing you. Life is pretty good. Now flip it. Revenue grows by 1%. Your loan suddenly costs 8%. Nothing else changed. Same business, same loan. But now the debt starts consuming a larger share of everything you earn. You haven't become irresponsible overnight. The relationship between growth and borrowing costs has changed. Countries experience exactly the same thing. If the economy grows faster than the average interest rate paid on government debt, the debt burden often becomes easier to manage over time. Businesses expand. People earn more. Tax revenues increase. The economy grows into the debt. But if interest rates stay above economic growth for a long time, the opposite happens. Servicing the debt absorbs more government resources. Borrowing becomes increasingly expensive. Budget decisions become harder. The pressure builds. Notice what caused the problem, not the existence of debt, the changing relationship between growth and interest. That's why economists spend so much time discussing interest rates. They're not obsessed with decimal points. They're trying to understand whether the engine of the economy is moving faster than the cost of financing it. Once I understood those three ideas, I couldn't read debt headlines the same way anymore. Before, I saw this: national debt reaches another record. Now my brain automatically asks, is the economy still growing? Have borrowing costs changed? Who's buying the new debt? Has investor confidence weakened? Is this debt issued in the country's own currency? It's amazing how quickly the emotional reaction disappears. Not because the debt stops mattering, because you finally have the tools to judge whether it matters. That's a much more useful skill than simply memorizing the latest number. But all of this still leaves one question, and it's probably the most important one in the entire video. Even if governments can manage debt, even if rolling it over is normal, why should you care? After all, you're probably not issuing Treasury bonds next Tuesday. So how does any of this affect your mortgage, your savings, or the price you pay to borrow money? The answer surprised me more than anything else I learned. Because government debt isn't just shaping government finances, it's quietly influencing yours, too. Up until now, it's been easy to think, that's interesting, but I don't work at the Treasury Department. Neither do I. So why spend 20 minutes learning about government debt? Because once I followed the money, I realized this wasn't really a story about governments. It was a story about the price of money itself. And whether you realize it or not, that price affects almost every major financial decision you'll ever make. Let's say you're buying your first home. You walk into a bank expecting to borrow money. The loan officer gives you two numbers. One is a 4% mortgage. The other is 8%. Same house, same salary, same person. But over the life of the loan, those two numbers could mean paying hundreds of thousands of dollars more. So here's the question I never thought to ask. Where did those numbers come from? Does the bank just pick one? Not really. Banks don't invent interest rates out of thin air. They build them on top of something else. And sitting underneath almost every interest rate in the economy is something we've already talked about: government bonds. Imagine you're an investor with $1 billion. You have two choices. You can lend your money to the US government, or you can lend it to a private company. Now, ask yourself something obvious. If the government is offering you a guaranteed 5% return, why would you lend to a private company for only 4%? You wouldn't. The private company has to offer more. Not because it's greedy, because it's riskier. That simple idea spreads through the entire financial system. Businesses pay more to borrow. Banks pay more to borrow. Those higher costs eventually reach home buyers, students, car buyers, credit card users, even small business owners trying to expand. It's like gravity. You don't notice it every second, but it's always there. Government bond yields quietly become the floor that almost every other borrowing cost is built upon. And that's when everything clicked for me. A headline about government borrowing wasn't just a story happening in Washington. It was quietly shaping decisions happening in millions of kitchens around the world. Think back to 2022 or 2023. Interest rates climbed rapidly across many developed economies. People suddenly started talking about mortgages again. House prices slowed. Monthly payments increased. Businesses delayed expansion. Consumers cut spending. At first glance, those all seem like separate stories. They're not. They're connected by the same thread. The price of borrowing money changed, and government bonds sit at the center of that system. That's why financial markets obsess over Treasury yields. Not because bonds are exciting, they're famously boring, but because they influence almost everything else. Once I understood that, economic news became much easier to decode. Whenever I heard bond yields surged today, my brain automatically translated it into plain English. Money just became more expensive. That's a much more useful sentence, because suddenly you can predict what might happen next. Higher mortgage rates, higher business borrowing costs, slower investment, pressure on stock valuations, more expensive government borrowing. One number rippling through an entire economy. The funny thing is, I started researching this video because I wanted to understand debt, but somewhere along the way, I realized I wasn't really learning about debt at all. I was learning about trust. Because if you strip away all the charts, all the economic jargon, all the trillion-dollar numbers, that's what this entire system runs on. Trust. People buy government bonds because they trust they'll be repaid. Banks lend money because they trust borrowers will repay them. Currencies hold value because people trust other people will accept them tomorrow. Even the number in your bank account only has meaning because millions of strangers collectively believe it does. Money isn't valuable because paper has value. Money is valuable because confidence does. And once confidence starts disappearing, things can unravel surprisingly quickly. History has shown that over and over again. Not just in debt crises, banking crises, currency crises, financial crashes. Confidence is often the first domino. Everything else falls afterward. That's why I think debt headlines often miss the point. They focus on the visible number, not the invisible foundation holding that number up. It's a bit like staring at the height of a skyscraper while ignoring the strength of its foundations. The height isn't meaningless, but it isn't the first thing an engineer worries about. The foundations are. Economies work in much the same way. The size of the debt matters, but confidence, growth, borrowing costs, institutional strength, those are the foundations. Ignore them, and the headline tells you almost nothing. At this point, I realized something I hadn't expected when I started making this video. The national debt isn't one of those topics where there's a simple right answer. It's one of those topics where asking better questions matters far more than memorizing better numbers. And honestly, I think that's a much more valuable lesson. Because the next time another record-breaking debt headline appears, and it will, you won't just react to the number. You'll know what questions to ask next. And those questions are where the real story begins. When I started researching this topic, I thought I was trying to answer one question. Is the national debt too high? Looking back, I don't think that was ever the right question, because after everything we've talked about, you can probably see what's missing. The number alone doesn't tell you whether a country is healthy. It doesn't tell you whether investors still have confidence. It doesn't tell you whether borrowing costs are rising faster than the economy. It doesn't tell you what currency the debt is issued in. And it certainly doesn't tell you whether that debt is financing productive investment or simply piling up without purpose. In other words, the number that dominates the headlines leaves out almost everything that actually matters. Think about it this way. Imagine your doctor walks into the room and says, "Your heart rate is 140. Should you panic?" You can't answer. Were you sprinting, sleeping, drinking coffee, lying on an operating table? The number only becomes meaningful once you understand the context. National debt works exactly the same way. $1 trillion, or 10 trillion, or 40 trillion isn't a diagnosis. It's one measurement inside a much bigger system. And once you understand the system, the number becomes far less mysterious. I think that's why this topic creates so much confusion online. Our brains love simple stories. Debt is bad. Debt is good. Print more money. Cut spending. Raise taxes. Balance the budget. Every opinion gets squeezed into a slogan because slogans spread faster than nuance. But economies aren't slogans, they're systems. Every decision solves one problem while creating another. Borrow too little during a recession, and unemployment can spiral. Borrow too much for years without productive growth, and future borrowing becomes more expensive. Raise taxes too aggressively, and you might slow investment. Cut spending too deeply, and you might weaken the very economy you're trying to protect. None of those decisions are free. Everyone comes with trade-offs. And once I accepted that, economics became much more interesting. Not because I found easy answers, because I stopped expecting them. There's another thing I didn't expect to learn. For years, I thought governments borrowed because they had no choice. Now I think that's only half the story. Sometimes governments borrow because they need to. Other times, they borrow because the financial system needs them to. That sentence felt completely backwards the first time I wrote it. So let me explain. Imagine tomorrow morning the US Treasury announced something unprecedented. We've decided to pay off every dollar of government debt. No more Treasury bonds, no more borrowing. It sounds incredible. The debt clock would stop forever. Politicians would probably hold press conferences. Headlines would celebrate the achievement. But somewhere else, another conversation would begin. Banks would ask, "Where do we store our reserves now?" Pension funds would ask, "What's our safest long-term investment now?" Insurance companies would ask, "What replaces treasuries on our balance sheet?" Central banks around the world would ask, "What becomes the world's risk-free asset?" The very thing that sounded like the perfect solution would create an entirely new problem. Not because debt is wonderful, because the modern financial system has been built around government bonds for generations. Remove one of its foundations, and you don't simply remove the debt. You change the architecture of global finance. That was probably the biggest surprise of this entire journey. Not that governments borrow, but that everyone else wants them to. So, let's come back to the question that started this video. Who's going to pay back the national debt? After everything we've explored, I don't think that's the question I'll ask anymore. Instead, I'll ask, can the economy continue supporting it? Are borrowing costs sustainable? Do investors still trust the government? Is the debt financing something productive? Has anything fundamentally changed? Those questions are harder. They're less satisfying. They don't fit neatly into a headline. But they're also the questions that professionals actually spend their time asking. And I think that's a much better way to think about economics. Not by memorizing answers, by learning to ask better questions. One of my favorite quotes comes from the Nobel Prize-winning physicist Richard Feynman. He said, "The first principle is that you must not fool yourself, and you are the easiest person to fool." I think about that quote whenever I read economic headlines, because it's incredibly easy to fool ourselves with big numbers. $37 trillion feels terrifying, just like a 140 heart rate sounds terrifying. until someone gives you the missing context. That's what this entire video has really been about. Not convincing you that debt is good or that debt is bad, but showing you why context beats headlines. Because once you understand the system underneath the number, you stop reacting to every new record. You start asking whether anything important has actually changed. And that's a much more powerful skill than simply knowing the latest debt total. If this video changed the way you think, even a little, then it accomplished exactly what I hoped it would. Because the goal was never to make you memorize economic jargon. It was to replace one misleading mental model with a better one. The next time someone says the national debt is out of control, maybe they're right, maybe they're wrong. But now you'll know the very first question to ask before agreeing with either side. Compared to what? And that single question is where real understanding begins. If you enjoyed this kind of deep dive, subscribe. Not because I'll tell you what to think, but because we'll keep doing what we did today. We'll take ideas that seem obvious, pull them apart, question every assumption, and rebuild them from first principles. Because once you learn how the system works, the headlines stop feeling like noise, and they start telling a story. One that's far more interesting than the numbers alone.